Okay, let's turn the calendar again.
Well, 2013, I think I'll start off with this one. I didn't have much to say on 2012 because everybody's just going to be holding their breath and planning for 2013, I think, in 2012. The big thing is 2013 we really start paying for this, and that's going to be felt a couple of different ways. One is there's a 0.9% increase on Medicare tax on the employee portion of Medicare tax. It will only apply to employees that make more than $250,000, and this gets back to the Obama administration's pledge to not tax people that make less than that. I've included a rather colorful slide in your handouts there, and as I looked at that, I thought that makes perfect sense to me, and other people look at it and probably think, what in the world are you talking about? So I want to explain that. The top line there is just what we call earned income, and so everyone probably is thinking, well, that's wages, but it could be more than that also. So for our business owners in the room, this tax is going to apply to you also. If you have income that's passing through to you from a partnership, and that's subject to self-employment tax, so self-employment tax and payroll tax are the same tax. They're called a different name because they're collected differently, but they are the same tax. So this is going to impact business owners. And so the top green line just shows income. The next two categories, one are the employer-paid taxes, and then the next category is the employee-paid taxes. And what I've done is I've broken out what the payroll tax or the self-employment tax is into its components. You can see that the yellow lines are FUTA, and they're going to be paid 6.5% by each party up to, I've picked 118,000, it's a guess. That number gets indexed for inflation every year. That's no different than our current system. That's nothing new. That's just to show you the breakdown. The 118,000 is just an estimate. Then you can see each payor of the tax, both the employer and the employee, pay the Medicare tax, the 1.45%, and that's on all earned income. Again, for employees, that's called compensation. For business owners, that may be income that's flowing through to them from a partnership that's subject to self-employment tax. That's no different than our current system. The difference is in the red. So we're going to see almost a 1% income, or almost a 1% tax on income over $250,000. As Bill said earlier, I've worked in the oil and gas industry quite a bit before I moved back to Kansas, and want to point out that if you have working interests in oil and gas properties, that is currently subject to self-employment tax. This tax will affect that income. So the three of you in the room that have that, that's you. So we're going to move on, not to take everyone else's time. Where more people are going to feel the impact of this is a 3.8% tax on unearned income. So the Obama administration says we're not going to tax people under $250,000, and they mean that as married filing joint. So the numbers are different if you're filing single or head of household or married filing separately. But I've got to pick one, so we're going to pick married filing joint. There's going to be a 3.8% tax on unearned income. Unearned income, you would think, is a fairly easy definition, but that's not actually what the bill calls it. That's what I call it. The bill calls it investment income. I've avoided calling it investment income because in the tax world, investment income has a specific definition. We know what that is, and it's not the same thing that they've defined here. So what will happen is if someone has, let's say someone has $250,000, or let's make it a different number, someone has $300,000 from compensation. And then on top of that, they have $10,000 of interest income or dividend income, or maybe it's rental income. See, rental income is unearned income unless you are in the trade or business of renting. So most people aren't who have rental income. So in that scenario, you may be an employee, makes $300,000 combined, married filing jointly, but you have $10,000 of unearned income. That $10,000 is going to be subject to your normal income tax plus this 3.8% tax. So suddenly, if you want to take the most extreme example, qualified dividend income right now is taxed at a long-term capital gain rate of 15%. Okay? I'm going to walk you through a couple of changes that are going to happen in the next 4 years where that income could be taxed at almost 44%. So you're going to be paying on that income almost 3 times the amount of tax. How many of you want to go invest in the stock market now? I didn't think so. No, actually, I'm not an investment advisor, so don't take that as investment advice. I'll advise you on the tax implications. But this 3.8% tax is on, I've included in your handout, the unearned income includes interest, dividends, capital gains, rents, royalties, and passive income. That passive income could be from partnerships or S corporations. Unearned income excludes the following. So it does not include municipal bond interest. I listened to a webcast from the American Institute of Certified Public Accountants the other day, and they were going over some of these changes. They were also going over trends that they would expect. One of the trends that they mentioned is they would expect to see an increase in the municipal bond and in the municipal bond market. If you think about, we're getting into an environment where this may be taxed at 45%, all of a sudden municipal bonds, which are tax exempt for federal purposes and maybe for state, depending on where you live and where they're from, all of a sudden that enhances the return on those investments. Also excluded are income from partnerships and S corporations in which the taxpayer actively participates. So if you're a business owner and you work in your business, that is earned income to you. Even the S corporation income that isn't subject to self-employment tax. So I don't want to make you all a bunch of tax tax consultants, or I wouldn't have a job. So, but I want you to understand there's a concept there where the government is at least trying to be consistent and saying, if you've got an S corporation, you're going to be required to pay yourself a salary that you're already required to, or the IRS will recharacterize some things. And so they're at least acknowledging that that's earned income and it's not going to be subject to this tax. So somebody did put some thought into that. IRAs and other qualified retirement plan distributions are excluded, and other income on which self-employment taxes are paid, like my oil and gas example earlier.